to be joined with the management team from Bupa as presented in the screen above. The call will start with the presentation and then we'll open the floor as usual for Q&A. We'll start with Hatem Jabal. Please go ahead.
Hello, Ahmed and all, and it's great to be with you here today. In this session, inshallah, we'll be sharing with you the conclusion of Bupa Arabia's result for the year 2025. And we will cover the financial performance, the market view, and we will share some highlights regarding Bupa Care Connect, which is Bupa Arabia's health provision arm, and some highlights regarding the recent insurance authorities strategy and other highlights. So I will hand it over to Abdurrahman to walk you through the financial results.
Thank you, Hatem. Assalamu alaikum. Good afternoon, everyone. Abdurrahman Saeed Daher, Senior Director of Finance Operation. For those of you who are joining us for the first time, a few insights about Bupa Arabia. Bupa Arabia has over 25 years of experience. Today, we're over 2,000 employees, serving over 3.8 million members through our vast network of 1,500 providers. And with the expansion into vertical integration, today we're proud of having over 100 doctors operating digitally and through our in-house clinics, which are standing at 25 clinics, with the ambition of having more physical footprint in the future, which we will explain in later slide. In the next slide, we take you through the journey of Bupa since it has gone public in 2008, where we started with merely a top line of 800 million. Fast forward today to the highest GWP ever of 20.5 billion riyal. That growth journey stands at a CAGR of 21%, well above the sector CAGR of 14.5%, and delivering significant value to the shareholders, where our profitability has increased from merely 69 billion in 2008. Fast forward 2025, we closed the earnings before tax of 1.25 billion, and we continue to deliver value through the appreciation of the stock since the inception of the company. In the next slide, we give you a quick refresh of our 3B strategy, which was launched in 2024, which is aimed to transform Bupa Arabia from an insurance company to a healthcare company. And definitely the recent announcement around the restructuring is a step in the right direction to enable the company to realize its vision. Now, looking at the pathways of the strategy, we have 3 different pillars: boosting the core, bending the curve, and beyond PMI. Now, moving ahead to 2025, and Yumkin, we've taken you through the journey of the previous quarters. If we can move to the next slide, please. Perfect. Yumkin, we've had a journey over 2025 that had certain challenges, especially at Q2. So Q1 was definitely a strong quarter for Bupa. However, Q2 we were faced by fierce pricing environment as well as above expectation inflation that definitely put pressure on our insurance margin. Immediately, the management has put in an intervention plan to try to rectify and try to introduce different interventions to support the profitability of the company and to improve the overall pricing environment within the market to enable us to pass such inflation to the customer and improve the profitability. And definitely since that impact, we've seen, alhamdulillah, positive trajectory into correcting that inflation that we've been faced. And collectively, we were able to add in 2025, despite the challenges, 2 billion in GWP in 2025, more than 2024. And that translated to 19.3 billion of insurance revenue. Out of the 2 billion we've added this year, the half of it came from the second half of the year, which will definitely support Bupa next year in realizing these GWP and insurance revenue. Now, looking at the insurance service margin, it reached 877 million, which is a 12% drop against last year. Now, if you look at the same percentage over the last 9 months, the gap was actually wider. Alhamdulillah, in Q4, we were able to post improvements in our insurance service results in Q4 2025 compared to 2024, which bridged slightly the gap that we've had in our net insurance service result in 2025 comparing to 2024. Now, looking ahead into investment income, alhamdulillah, we've been able to continuously outperform last year's figure, where we've reached a record high of 730 million of investment income in 2025, leading to the 1.3 billion earnings before tax, which is an 8% drop from last year. Now, in the next slide, we'll just show you a waterfall of the movement in profitability between 2024 and 2025, whereby the majority of the drop in the profitability is driven by the change in the insurance service result, which is a factor of the inflation that we spoke about in the past. Investment income has increased compared to last year. However, it's been slightly offset by the increase in other expenses as a result of the continued investments that we're doing throughout the business to realize our strategic ambition. In the next slide, we will hand it over to Ahmed Bajnaid, our Chief Investment Officer, to give us a view of the investment portfolio and results. Ahmed?
Thank you, Abdurrahman. Welcome, everyone, and thanks for joining us. I think, as mentioned earlier, thankfully, it's been a great year for the investment income results, closing 2025 at 731 million, almost 9% growth compared to 2024. And this is basically a result of the duration extension strategy that we've started exercising in 2024. As you've all seen, 2025 has been very, very volatile, the least to say, in terms of what has happened to the yields and rates. We've seen some rate cuts going into 2026. The picture is still blurry, but anywhere between 2 to 4 rate cuts is on the table until time shows exactly what could happen. The portfolio is well positioned regardless of the rates of the direction. And obviously, if interest rates continue sliding down, it will give us better positioning when it comes to potential capital gains in the Sukuk book. So we're expecting, inshallah, a resilient and stable investment income going into 2026. No major changes in the portfolio composition, as you see, between 2024 and 2025. A bit of more deployment into the Sukuk space, but it's a bit masked by the growth in the size of the portfolio. And equity remains an opportunistic allocation. It has increased compared to the same period of 2024, but mostly toward the end of the year, just to be opportunistic and see if we can generate a bit of capital gains in the space going into 2026. Thank you, and happy to answer any questions at the Q&A session.
Thank you, Ahmed. Looking at the market performance and trends, and given that, again, Bupa has announced its results in January, while the rest of the market has not yet announced their financial results, we'll be sharing with you the 9-month view over the market share and positioning, and reflecting both at the total insurance market level and zooming in at the health insurance level, both at which the market share of Bupa Arabia remains consistent in 2025 compared to 2024, standing at 27% market share on the overall market and 45% in the health insurance market. Now, looking ahead at the performance of the different components of the P&L of the entire market, despite the growth that we've seen in the insurance revenue of 7.5% year on year, we saw a significant deterioration in the insurance service results by 40%, which translated to a significant drop in the earnings before tax for the entire sector of 37%. Now, looking into the health insurance market, in the next slide, the insurance revenue has actually increased by 10%, and the insurance service results grown by 24%. Now, To zoom into that number, you can tell that beyond the two biggest players in the health insurance space, the majority of the other players were actually loss-making in 2024 and have either moved into break-even or a slightly profitable position, or they've lowered their losses in 2025, which contributed to that percentage being improved. Looking at the segmentation over the 9 months, Bupa continues to be the market leader at the corporate and the higher end of the SME, with small enterprises actually creating a larger market share in 2025 compared to 2024. With that, I'll hand it over to Mr. Ali Shneimer, our Chief Business Development and Marketing Officer, to give us a view of the market dynamics. Ali?
Thank you, Abdurrahman, and welcome everyone. I mean, in the following couple of slides, we focus on the trends of the insured lives in the market. The numbers on the slides up to end of Q3, we have seen strong growth, almost 10% growth versus same period year ago. In fact, the close of 2025, if you go to CHI website, it's around 14.5 million lives. And that's driven mainly by the increase in the employment market. Quick numbers on the employment, 2025 closed around 13.48 million employees in Saudi. And that's a significant growth, almost 8.4% versus 2024. As a result, you have seen the growth in the gross written premiums in the market. The growth has been universal within Saudis and expats. Expats are growing at a faster pace, given that there are lots of projects, especially within the construction and real estate market. So we have seen them growing double digits for almost 2 years in a row, versus Saudis growing at a single digit moving forward. The second slide, looking at again, this is a more detailed trend on quarterly basis, just to see the buildup and how things are progressing. We continue to be optimistic about the growth in terms of a number of lives to be covered. The enforcement gap remains on the following slide, and later on I'm going to share a glimpse of the national insurance strategy, because lots of analysts have reached out when it was announced, asking about some details on the strategy. Thankfully, we have received materials just to share quick snapshots of the national strategy with more focus on health, because it is relevant to our business. However, the gap remains big in terms of enforcement, and actually it is the second initiative on the key initiatives when it comes to health, as shown on the national insurance strategy, to close the gap. And that is encouraging when it is part of the national insurance strategy. I'll come to the national insurance strategy in a bit, once we just take you through our view on the inflation trends in the market with Nasser.
Thank you, Ali. Assalamu alaikum and welcome everyone. Turning to the medical inflation, in general, we continue to see elevated trend but stabilized. For 2025 in specific, we expect to close at 10.6%, which is fully in line with our last quarter estimate and reflects the normalization of prior pressures driven by new claimant and the shift toward high cost providers, and no further fundamental change relative to last quarter. For 2026, our expectation remain unchanged at 10.4%. We continue to anticipate a similar inflationary environment to 2025, driven mainly by the pure inflation, as well as the increase for Article 11 provider maturity and mainly the readiness of Article 11 providers. It is important to highlight basically the trend is not unique to Bupa, but also aligns with the broader market dynamics. Would also mention that the latest report by ION, the Global Medical Trend Report, estimated the market inflation at 10%, supported also by the result from the publicly listed provider. Also, we're showing here the overall seasonality of our result relative to the publicly listed provider to show how it's highly correlated across the different seasons. That was a quick update on inflation. Happy to answer question in the Q&A. We'll leave you now with Mohsen for Bupa Care Connect update. To you, Mohsen.
Thank you, Nasser. Assalamu alaikum. Good morning and good afternoon, everyone. Happy to be back on the webcast, this time talking about Care Connect. I'm pleased to share that this year has been transformational for us, and we have completed the build-up of our integrated care platform, which has been marked by exceptional growth, and we will talk about the growth that has taken place in 2025. And we have seen operational expansion and significant advancement in terms of our digital capabilities. Just to recap on what Care Connect does in essence. So our care model, they drive both clinical outcomes and economic value for our customers and for our members. And the way we do it, we operate a sophisticated risk stratification models. And these models, they match, in essence, the intervention intensity with the member needs. So this is it isn't a one-size-fits-all for all healthcare. So every category of the members or the population has its own mode of engagement. And for our high-risk chronic patients, for instance, we provide proactive enrollment with dedicated health navigators and personalized treatment. And we try to drive adherence and prevention of costly complications as much as possible. For the second bucket, which is the severely ill members, we eliminate friction through granting those members pre-approval and integrating them into the journey across multiple specialties and across multiple services. When it comes to the digital clinic, it serves the majority of the members, and it goes without approvals requirement, and it's also integrated across multiple specialties, and it provides the members with a lot of convenient services such as medication delivery at home, home-based labs, and also home healthcare at homes beyond labs. So in essence, the pyramid is basically it's a way for us to deploy resources in an efficient manner while we focus on improving member satisfaction and health outcomes for our population. Next slide, please. So when it comes to 2025 highlights, I mean, we served around 300,000 unique members within our ecosystem, and this represents a significant penetration of the Bupa Arabia member base. We delivered around 1.5 million total member interaction, demonstrating the stickiness of Bupa Care Connect and the frequency of engagement to our platforms. I mean, these interactions happen across different services. As you can see in front of you on the slide, we have managed to conduct around 715,000 telehealth consultation, which showcases the power of the digital first access, which was a challenge for us at the beginning, but we managed to get through it and educate and make people aware of their digital capabilities and the fact that they can do any consultation, from any convenient place. Also, we managed to complete around 300,000 home care or home-based services. These are primarily services of different natures, primarily focused on home-based labs. And also, we managed to deliver around 500,000 medication ordered fulfilled through our integrated pharmacy network. We're now operating around 25 in-house cooperative clinics. So these are clinics sitting at the premises of our customers, and we have plans to grow that network even further in 26. Our digital clinic by itself deploys around or employs around 57 doctors. These are doctors, full-timers across different specialties and across different levels of expertise. So when it comes for the key updates across different care streams, so the way we see things in Bupa Care Connect, so we have 5 key streams of services, as I mentioned. The first one, which is the digital clinic. So we recently launched the instant consultation, which is now live on the app. So we enable our members to access real-time doctor in a click of a button. We also launched Nabd Health Connect, which is basically a very comprehensive medical content platform that is fully integrated with our app. It provides personalized health resource in Arabic, and obviously it provides a lot of medical content to navigate through different questionnaires for the members. When it comes to the second bucket, which is our Bupa clinics, or as we call them, the ICCs, integrated care clinics. So we are about to launch our first clinic in the first quarter of 26. This is going to be a state-of-the-art clinic, and inshallah, once it's completely ready, we will we'll have more announcement on the clinic. There is also the second clinic that is in progress, and we have also the plan to launch it in 2026. So these are clinics designed to serve the high-end premium members within our network, and it will provide complementary services to our digital clinic. For all of the members that require physical intervention, they will have direct access to our clinics. When it comes to the home health care, the plan is to serve our members nationwide. So we started with the Eastern region, and now we're in progress to complete the requirement to have our own home health care license in the Western region. And obviously, with the opening of the clinic, we will have access to home health care services within the Central region as well. As I mentioned, on the in-house clinics or the corporate health centers, we have 25 that are operational today. These are clinics, as I mentioned, that sit inside the premises of our customers, and we have plans to expand that. These clinics, the good news is that these clinics are integrated to a certain extent with our ecosystem. So any member that visits the clinic has access to a shared database when it comes to getting access to the variety of services provided by the Bupa Care Connect ecosystem. When it comes to medication delivery, home-based labs, home-based care, all of that is integrated within the same systems and provides convenience and efficiency to our members. Last but not least, which is one of the most important things that we do within Care Connect, which is focusing clearly on our chronic care programs. So these are programs that are specifically personalized and designed for our chronic care members. In 2025, we managed to onboard more than 57,000 members that are enjoying our convenient services when it comes to chronic care, adherence to medication, follow-up consultations, making sure that all of these members have continuous improvement on their health outcomes. Think about an uncontrolled diabetes member who joins the program and then ends up after a full year of adherence to the program, seeing his HbA1c controlled. So these are the programs that are making differences to people's lives, and we are creating success stories out of these programs. This is basically the key updates for 2026. For 2025. Next slide, please. I'll hand it over back to Ali on the other highlights, and happy to take questions in the Q&A. Thank you.
Thank you, Mohsen. We will only talk about the new ones, and the biggest one is the restructuring. Probably Hatem want to shed some light on the Bupa Arabia restructuring and moving into a holding structure.
Thank you, Ali. So we have recently announced that we got the initial non-objection and approval of our board to restructure to a holding structure. And then we've received a lot of questions that I would like to address. First of all, how the restructure would look like and the objective of the restructure we are going through. However, you should expect, as a next step, a detailed circular to be issued in the near future with more details regarding the restructure. However, just to give you a high level, Bupa Arabia Insurance Company is currently a publicly listed company that owns Bupa TPA and Bupa Care Connect, which is the provisional arm. In the future, we will transform into a holding structure where the publicly listed company would be the holding that owns an insurance business and a provision business. And the intent of such restructure is to enable the company to grow and expand into the future to achieve its vision of developing a healthcare ecosystem where we can serve our members better, ensure they have better health outcome, and control the experience of the healthcare services. It's worth mentioning that this is the first demerger that happens for a publicly listed company. So we are handling it in diligence with the regulators to make sure we execute it in the best way possible. And the main intent, as I mentioned, is to enable the company to have the vehicle for growth, enabling it to expand into different line within the healthcare ecosystem. As I mentioned, I'm restricted to the information that we are sharing now to what was announced publicly. However, you should expect a public circular soon, which would be issued for final voting from shareholders to go on with the restructure, hopefully later within the year. Next slide. Back to you, Ali.
Thank you, Hatem. I mean, the star marked news here has been already covered by Hatem on the restructuring. So that's when the updates related or the highlights related to Bupa Arabia. I will move to the highlights related to the regulators. And the one most important is the approval of the National Insurance Strategy by the Council of Ministers, which was announced 2 weeks ago. This has been the long-awaited strategy by Insurance Authority, and now it is basically in motion. Insurance Authority have held a few workshops with the CEOs of insurance companies to share with them the highlights of the strategy. And I believe they also plan to engage a broader audience in the business community to share with them the strategy. I have extracted a slide or two just to share key highlights of the insurance strategy. As you can see, they have worked on a detailed strategy. Unfortunately, the materials so far are in Arabic, so probably they will have an English version when they share this with the business community. But they have identified 11 key challenges across the supply, demand, and the market structure. And that was the base for the strategy, how to address the challenges. The Insurance Authority has identified almost 72 strategic initiatives on top of the needed enablers from regulations and other government bodies to address these challenges. The key highlights when it comes to health insurance specifically, we are talking about growing the premiums in the market to almost 80 billion by 2030. And the second initiative on the health slide is the enforcement, which shows the importance of this issue that has been, undealt with for quite some time. This is envisioned to actually grow the number of insured by almost 5.8 million if the gap is fully closed. Insurance Authority expects that the number of insured lives by 2030 to be around 23 million lives. Mind you, we closed 2025 at 14.5 million insured lives. So when you close the gap of around 5.8, that takes you to 20.3, and then you add to it the normal population growth. And I believe this number does not include Umrah or tourism, because in 2025, collectively, all the inbound travel, whether normal business and family travel visits or the tourist visas or the Umrah combined, probably they reach around 20 million visitors who were covered under the emergency-based insurance in 2025. So the number shared here of 23 million members under the health insurance does not include the emergency-based insurance for tourists and Umrah. So these are the key highlights of the strategy specifically related to health insurance. They have more details on other lines of insurance, which I thought were not of interest, at least to us, given our focus within the healthcare. And the rest, these are the brag sheet that we share. Probably I will just leave it there for those who would check it later on our investor relations website. And I think a better use of time is to open the floor for Q&A.
Thank you very much to all participants on the call. If you wish to ask questions, you can either send them through the chat or you can use the raise hand function. We'll start with Varuna from SICO. Please unmute yourself and go ahead.
Hello, hi, good afternoon. Am I audible?
Yes, you are.
Hi, thank you, Ahmed. Thank you to the management, and thanks a lot for very useful presentation. Appreciate you taking time to discuss the details of the national insurance strategy as well. I have 3 questions. The first one is on the strategy itself. Like Ali mentioned now, if we dissect this target of going from 14.5 million to 23 million, I think there is a gap of probably about 3.5 million of primary members uninsured, and there are about probably 2 to 2.5 million of dependents. So there's a big gap of underpenetrated, unenforced portion, which I think they are trying to started addressing by issuing like a white paper to discuss how to enforce this in terms of penalties and those who are not complying. So I just want to know where has this consultation reached, and what are the timelines that we are talking about in terms of in that regard. That's my first question. And secondly, on the claim seasonality, in the slide that to discuss about the medical inflation, you could historically you could clearly see that there's a after 4Q there's a steep decline towards Ramadan. But when I see the CHI website, the latest data, because they give the claims data on monthly basis. I haven't really verified this data, but the data still shows that even January is still elevated, that is even higher than last year, much higher than last year. So I want to know that you have so far managed to manage this, I mean, the issues that you had earlier in the year, you managed to sort out in the past 2 quarters. How are you seeing this going forward, especially in the 1Q? So that's my second question. And third question is
Sorry,
on the...
Varuna, can you keep the third to last and note to everyone? I'm sorry to interrupt you, but note to everyone because we have a long queue ahead of
Sure,
us.
sure,
If
sure. I'll go back in
you're
the queue for the
done with
last.
the questions, you can come back. Thank you very
Sure,
much.
sure.
Thanks, Varun. I'll answer the first question, although might not be an answer. I'm not aware yet of a detailed plan on all the initiatives under the strategy. And mind you, I mean, the strategy was just approved 2 weeks ago, and they are in the process of just sharing that strategy with the sector and stakeholders. So there are no timelines set, but I know that this is a key initiative because this would be the biggest contributor to the growth in the market. As you rightly said, today 14.5, for you to reach 23 million by 2030, you already have 5.8 million identified as a gap today between employees and their dependents. So it is the biggest contributor, the single biggest contributor to the growth in terms of number of lives. So I'd assume it is a key priority on their initiative list. There are no timelines shared at this point of time. When they do, definitely we will share it with the business community. The second question on the claims, before you answer, Hatem, I mean, just I know you are following some dashboard on CHR website. I'm not sure of the accuracy of such data. So you need to take that with a grain of salt, Varuna.
All right.
So, hello, Aruna, and allow me to address the second point, and I'll address it from the perspective of the data and the claims we are seeing. And by the way, what you mentioned is not wrong. You do usually see an escalation happening toward the end of the year, beginning of the year after. However, last 2 years, we have seen an improvement in Q1 due to the shift of the seasonality of Ramadan becoming in Q1, which is why you see the improvement year on year. But you're right in the sense that you do see the escalation sometime toward the beginning of the year. However, if I mention the second part of your question, which is the trend of the seasonality, the seasonality of the claim we've been seeing. Yes, you're right that, and this is reflected in our result. If you've seen our Q1 results, was the highest ever in 2025 because of the shift of seasonality, and then we were heavily impacted in Q2, and we started highlighting that the trajectory of inflation went back into double digits, which is the 10% we are presenting, and that continued into Q3. However, around that time, we started taking corrective measures into reflecting that higher than usual inflation, because closing of 24, beginning of 25, we've seen single digit year on year, and then it went back into double digit. Hence, we took corrective measure. Now, you asked about the result, and you can see it if you isolate our numbers for Q4 only. You would see that there is already an improvement. So quarter on quarter, we are slightly better than the year before due to the corrective measure we've taken toward the second half of the year. And we already see the market overall correcting by moving from low single digit toward in the first half of 2025 to double digit increases in the second half of the year to counter the inflation that we've seen during the year. So yes, it's still double digit. However, the market is correcting, and we see the improvement already in our Q4 results.
All right. Thank you very much. I'll go back in the queue for the last question. Thank you.
Sure.
Thank you, Varun. We'll take next question from the line of Anchor from HSBC. And a reminder, please just limit yourself to 2 questions. Unmute yourself, please, and go ahead. Anchor, please, can you try to... 1 second, I'll try to unmute you from my end. Can you try again, please?
Am I audible now? I'm unmuted.
Yes, you are. Go ahead, please.
Okay, thank you, management, for the call and the presentation. So I think just wanted to understand that you started repricing your book because of the inflation in the second quarter. Would you say that most of the repricing is done? And I think we should see the benefit of that in the margins in 2026. And when can we start expecting the margin improvement because of the repricing? That's my first question. And my second question really is that, I mean, the move to the holdco structure, does it signal moving beyond primary healthcare for Care Connect? Or, I mean, in the sense that it does give you more regulatory flexibility to get into secondary and tertiary healthcare? Is that the main reason, or there's something else? I think those two from my side, and I'll join the queue for two more maybe.
Thank you, Anchor. And if we can please go to the inflation slide just to explain this point clearer. So to your point, Anchor, yes, we did the reprice and we started seeing that already. If you recall, if I actually look at the closing of 24, it was the first year of single digits, and the trend was going downward, and then it reversed again. We did take corrective measure, and the aim and the target is to improve the margins in the year 2026. However, we also anticipate inflation to stay at that level. So right now, not only Bupa, but if you review the results of the market in Q3 and expect it to be seen in Q4, you would expect to see adjustments and as you see growth in GWP behind the corrective measure. We are aiming for improving the margins back to the levels we've had in 24. And that's our aim for the year 2026. But we do anticipate inflation to continue with the same trajectory. With your second point, right now, by the way, the restructuring has been under discussion with regulators for many years now, so it's nothing new. And the objective, as I highlighted, is to enable us to expand into healthcare. Right now, what we are focusing on is primary care. However, the full model of Bupa globally in the different markets expands beyond that. However, for us in Bupa Arabia, our focus now is in primary care, as this is the area where we believe we can add value to our members. However, the full model could capture different touch points in the future.
All right, many thanks. This is helpful. I think just a small follow-up on the first question. That basically, if I summarize 2025, we were unable to preempt the consumer behavior of using more premium providers, right? That's what you mentioned in the second quarter earnings call. But now, obviously, we have a view on that. And there are pricing strategies that you would implement to offset that trend, right? Is that how we should think about it?
It's already in place, yes.
All right, perfect. Thank you.
No problem.
Thank you very much. We'll take questions from the line of Chiro Ghosh from SICO. Please unmute yourself and go ahead.
Hi, this is Chiro Ghosh from SICO Bahrain. So I have a couple of questions. So the first one is the new Zakat rule. If you can give us some more clarity on that, so that will be very helpful. I mean, how should we model it in our, how should we model it? That's my first question. And the second one is, if you can, I know it's too early about the Bupa Care. So what kind of revenue contribution can we expect, say, 2 years down the line or 3 years down the line? Any guidance on that would be helpful. Plus, also, if you can say some kind of EBITDA break-even point. So if you can give some numerical direction, that will be very helpful. Yeah, these are my two questions.
Sure, you can allow me, Hatem, to take the Zakat point, and then I'll hand it back to you. So the new Zakat regulations were introduced this year, introducing new mechanisms where a cap and a floor has been introduced. Now, the challenge that we have as an insurance sector, the guidelines for insurance company remains to have certain gray areas that would require time and discussions with the regulator to try to uncover and see how we can best translate these regulations into reality when it comes to insurance. However, as of now, we don't expect the new regulations for Bupa to significantly change the Zakah charge. What you see in the financial statement, the decrease in the Zakah expense, it includes a one-off reversal for certain years where we have settled with the regulator at a lower amount than what we had provisioned for. And accordingly, we've realized a one-time benefit of that reversal, which is shown in our financial statement notes. If you take out that one-off amount, the amount remains similar to last year, given that we have a similar Zakah base and equity position in 2025 compared to 2024. So definitely, we are in the middle of discussions with the regulator to try to unpack the regulations for insurance company, and definitely there's a learning curve for both the regulator and the sector. However, for Bupa, we don't expect material difference, at least for the foreseeable future.
Thank you, Abdurrahman. And then Shiro, I'll address your second point regarding Bupa Care Connect. And we actually highlighted some of the targets we are aiming for in previous call, but allow me just to remind also the audience that one is what we are aiming to do is to improve the medical outcome and have offer a better experience to our members. So we have an internal target for the improved NPS score for the services, the healthcare services we are providing through Care Connect. And as we, in terms of the revenue target, we are building a similar model to what we have in Bupa globally, which allowed other regions to control 10 to 15% of their claims within their provision ecosystem, and that's our aim. However, when we announce our results, you see the full combined results of Bupa Arabia Insurance and the provision arm combined. But as a rule of thumb, we are aiming to serve 10 to 15% of our members within our ecosystem and improve the service outcome of that as well.
Just a follow-up on this one. So do you expect the visitor of this clinic would come primarily for proximity, or there would be some additional advantage for somebody to come to Bupa clinic, this Bupa Care Clinic?
So right now we see it as an extension to our ecosystem. So we started with healthcare services. So we would use it as a referral of that extension. So hopefully we'll be able to serve you digitally, and there is a need for physical intervention, you would be referred to the clinics. So that's the main use of the clinic. And I forgot also to mention that the aim is to optimize the spend through those clinics, which would improve our loss ratio by around 1%. It's not the strategy is not a regular brick and mortar approach where you open up clinics and you wait for people to walk in, rather than use it as a touch point to serve members that we are already serving through our digital clinics or who are already in our insurance book.
Very clear. Thank you very much. That's all from my side.
Thanks a lot. We'll take questions from the line of Abdullah bin Masad. Please unmute yourself and go ahead.
Assalamu alaikum. Congrats on your 2025 performance. I have more of a general question regarding your performance relative to the sector. I just want to understand the deviation between Bupa performance at insurance service result and the overall market. And we used to see Bupa ahead of the curve in terms of pricing usually, and during 2025 it seems the other way around. It might be not true, but I just want to understand, even if their competitors are delaying the inflation on their numbers, how's the situation for the overall market?
No, that's a very good question, and allow me to address that. Actually, there are two factors that are going into play here. One is if you look at if we can go back to the slide of the insurance sector margin, you would see that the market is correcting from being extremely negative to less negative. So the market has been correcting from a much lower base. Actually, the next slide. The healthcare sector, next one. Yeah. So if you look at the market has been correcting from very negative to better results, which is the improvement you are seeing in the results and the margin overall, where Bupa was actually on the higher end when it comes to margin. The second point is the concentration of the high inflation happened on the high end of the book, where we have a higher representation versus the market, and this was the main driver of the inflation of members going to high unit cost providers and higher concentration for those providers, which drove the higher inflation for Bupa. These are the two reasons that resulted in our performance being lower than the previous year, while the market was already in correction mode, recovering some of the negative margins.
One more question, Hatem, if you allow me, regarding Expro. Mid-year, you were talking about improvement in Expro. How do you see the situation there currently, and how's the overall competition over Expro accounts?
Look, the competition is still there. However, Expro similar to the rest of the book, we are seeing a correction in the market in the second half. We are seeing higher increases for both Expro and non-Expro, but the competition is still there. However, hopefully the margin of that segment should improve in not only second half of the year, but also going into 26.
Clear. الله يعطيك العافية. Wish you all the best.
Thank you.
Thank you very much. We'll take questions from the line of Abdullah Buraidi. Please unmute yourself and go ahead.
Am I audible?
Yes, you are. Please go ahead.
Yeah, thank you very much for the presentation and congrats on the recovery. This is Abdullah Buraidi from Emirates NBD. I have two questions, one on the investment and one on the insurance. On the investment side, we notice an increased allocation to equity, mainly in the second half, as we see the amount allocated to funds under the fair value has increased from lower than 700 million to around 1.9. Is this the funds that we see? Is it mainly equity or is it fixed income? And if it's equity, we still see high rates in the markets and a possibility for locking duration. And from what it seems like, this equity allocation has pressured a little bit on the investment results. We see a 34 million decline in fair value on that equity in the fourth quarter. Could you clarify on this, if I'm linking it correctly, on the insurance after this question?
Thank you so much for the question. The allocation to equities is not through the funds. Today, I think there is a classification, accounting classification that has to do with the subordinated credit, the PERPs, and they have to be classified as equities under the financial statements. Our exposure today to equities is shy of 400 million riyals. The funds allocation is mostly in money market funds and some private credit opportunities. So our equities allocation is less than 400 million riyals as of the end of 2025.
Okay, and we see an unrealized loss of 34 million in the investment fair value movement. Could you attribute this to which security class, asset class?
Unrealized losses is mostly in some sukuk positions, in addition to movement in the private credit funds.
Okay, yeah, thank you very much. That's very informative. On the insurance side of the business, we notice on a couple of government entities that used to be Expro, and as you mentioned, that Expro was one of the main pressure points for the loss ratio. We notice them reducing the classes more and more, and it is not on an entity or two. It seems to be wider than this. Do you see this as a positive sign and enhancing the loss ratio going forward for the written premiums?
Hello, Abdullah. Actually, we haven't seen any changes. So Expro has a unified table of benefit for all the entities under it, and it has not been changed. Usually, it's renewed at the end of each year, beginning of the year in January, but we haven't seen any change for those under Expro. There might be for some entities that are going direct, but for Expro table of benefit, no change have taken place yet.
Okay, and given that the price list of most provider hasn't been changed year over year, and you've seen the behavior that took place last year, and you've seen Expro unfolding for maybe 2 years now, should we expect that the loss ratio go back to 2024 levels?
You're talking about the loss ratio overall, or you're talking about Expro?
Both, if you may.
Look, the loss ratio should improve. Again, when you look at the sector overall, it's still largely in the negative, with the exception of the large two companies and some smaller ones. So, given the high inflationary environment, usually we are at a similar cycle to what we had in 2021 going into 2022, where we have seen high inflation that required an adjustment. For some companies, it corrected within the year after. For others, it corrected in 2023, so 2 years down the road. But with the current level of with the current margin, net insurance results margin, and net insurance results, you should expect the sector to correct. And however, the only thing I cannot answer is whether you would see the recovery fully in 26, or it would take one more year, similar to what happened in 21, 22, 23.
Okay, thank you very much. Very informative, and وفقكم الله.
يعطيك العافية. شكرا.
We'll take questions from the line of Abdulaziz. Please introduce yourself and start with your 2 questions, and unmute yourself as well, please.
Thanks for taking my question. This is Abdulaziz Hbeshi from Jadwa Investment. So we have noted a recognition of approximately 90 million in the provisions related to under contract in 2025, relative to zero back in 2024 for the full year. Can you elaborate on the drivers of this increase? Specifically, was this primarily attributed to higher than anticipated medical inflation relative to the initial assumptions at the start of the year, or was it linked to the timing and mix of the newly onboarded policies, particularly those in the third quarter? Also, we have seen, we have always viewed Bupa as a prudent company when it comes to provisioning. We have seen more releases through the changes in the past services compared to the incurred claims in 2025 relative to the previous years. If you could just elaborate on what have changed there. Last question related to the cost of the physicians the care connect. Where do you book these costs? Do you book it at the OPEX, or is it part of the insurance operations? Thank
Sorry, can you repeat the last question, because we lost you in the middle of?
It was related to the salaries of the physicians. Where do you book it? Is it part of the insurance operation, or is it part of the OPEX?
So Nasser, you want to take the first point on reserve and onerous contract?
Sure. Thank you, Abdulaziz, for the question. So in terms of onerous contract, let's start with explaining the onerous contract provision. So the company books onerous contract provision in case the remaining coverage or your UBR is expected to be less than the expected claims, plus additional risk adjustments. So you rightly said the a new mix of members can influence basically the recognition of onerous contract, seasonality, inflation as well. But mainly the main driver of the increase of this year relative to last year is the higher inflation that we're talking about during H1 mainly. So the 88 million is related to the policy that was written during Q1 and Q2 and experienced higher inflation than expected. Hence, we had to book loss component. And again, just want to highlight one more thing, that this loss component that was booked includes risk margin as per standard. So that doesn't really mean that these policy are loss making. However, we might basically book this loss component because of the risk margin that is mandated by the standard. This is in terms of the first question. The second one regarding the movement in the bus surface. In general, the overall predictions and reserving methodologies are exactly the same and consistent. However, this year we experienced the growth in general in the business, especially SME. So this is a new mix of portfolio, but what really lead to the increase of the movement in the bus surface is the new pattern of Article 11 submissions. So given the change in the Article 11 submission and the acceleration during the last quarter, the last basically periods, we had to offset these and encounter the pattern of that submission. Hence, you see the increase in the movement of bus surface.
As far as the third question regarding the expenses of the physicians, so these are partly, they are included in the insurance service expense as part of the other directly attributable expenses. This is due to the fact that these expenses are incurred to service insurance contract members exclusively, and therefore by standard, we're classifying them as part of the other directly attributable expenses.
Just a small follow-up on the last one. Regardless of the utilization, they are always booked as part of the insurance operations. Is that correct, Abdulrahman?
Yes, so اليوم you are required every expense within your company to be either linked to either acquiring the insurance contract or servicing the insurance contract. So you're required to do an expense allocation methodology for every real that you expense throughout the year. And if it's linked to servicing an insurance contract, by standard, you have to allocate it to the insurance service expense. And accordingly, they are charged there.
Thank you and good luck. Thanks, Nasra.
All right, we move on to questions from the line of Madhu from Rashhi. Please unmute yourself and go ahead.
Thank you, Ahmed, for the opportunity. My question is a follow-up to what the earlier participant asked, but my question is mainly focused on quarter four, because there were several tailwinds for quarter four. One was the price improvement, both ex-pro and non-ex-pro, and at the same time, pre-authorization for MOH hospitals also kicked in from November. Hospital expectations from hospitals are not that great. So I'm just wondering, what is the reason for such high incurred claims? And when I look at the accounting entries, there was a reversal in on-race contract, which means your expectations in terms of higher claims would have been lowered down. Also, adjustment to past services had a positive impact. Despite all this, you barely made any money on insurance service level. Just wanted to understand, is it related to the change in claims pattern, or are you increasing your or building your reserves? Because over the last 3-4 years, what I have noticed is that GWP as a percentage of equity or insurance contract liability, if you look at it, has come down, which means maybe you were utilizing the past reserves to manage the claims, but now you have reached a level where you need to shore up your reserves. So can we assume that this year, particularly in Q4, the increase in incurred claims has an element of reserves being increased? If yes, then how much is that? So that is question number one. Second, follow up on Zatka. You talked about floor and cap. Could you shed more light here? How much is that and how would that be calculated? And for you, yes, the impact could be limited because you do not have long term liabilities. But what should we expect for other insurance companies? And is Zatka proposal only limited to long term liabilities? Because there were speculations that even IBNR would be included in the Zakat base. So these are my two questions.
So let me take the last point and then maybe I'll hand it to Nasser or Hatem to explain. Now, to be honest, it's not as straightforward as it seems when talking about the floor and the cap. The floor goes into the profits of the year. The cap looks at the equity. Now, what you're mentioning today is a gray area that is not yet clear by the regulator, which is the definition of equity. There are certain discussions in the market that do you view IBNR as equity, yes or no? The general consensus of the market, and we're working closely with the regulator to confirm that reserves are normal accruals, which are retained to cover expenses that have already incurred, and they are an expected outflow as part of the policyholder book, and accordingly, it shouldn't constitute part of the shareholder equity. And therefore, it should not be part of your definition of equity as per Zakah regulations. What we can confirm now is that the regulations do not mention that insurance reserves should be treated as equity. And therefore, today it's not a risk. However, what we're working towards with Zatka and with the support of the Insurance Authority is to ensure that the insurance guidelines distributed clarify that point to ensure that this risk is removed. Now, it would be very difficult to give you a conclusion for the sector, given that each company is quite unique, especially when looking at their long-term contracts and looking at their classification between current and non-current assets and liabilities. Today, the balance sheet of insurance companies does not show a liquidity split, and that liquidity split is a part of the calculation of Zatka of the determining the Zakah base, as well as the cap. So concluding on a high level, it's very difficult. It will vary company by company. And what we're anticipating for Bupa, given that the tail of the contracts are short, we shouldn't see a significant impact irrespective of the outcome of the guidelines issuance by the regulator. يمكن with that, I'll hand it to Hatem or Nasser to respond on the other point.
Yeah, sure. I'll take the reserve part. So, and then you started with the seasonality and the overall trend of Q4. If you see basically the graph, always Q4 is the highest season across the year, and basically driven by the schooling calendar, the winter season, and the increase in frequency in general. So this year is not different from previous years. It is exactly what we expected for Q4 in specific. Hence, our projection for 2025 has not changed. In terms of the reversal, and did the reversal help our result or not? Technically, no, because we expected, as usual, that loss component will be impacted by seasonality. So, for example, Q2, Q3 will book higher loss component because of the remaining coverage of the contracts in general, and our overall portfolio will be in a high season. Hence, we need to book additional reserves, and we reverse it back as the season, as the year basically closed. So even from last year and the previous years, this is the overall pattern in terms of the onerous. So the release that was in the onerous contracts is driven by seasonality, nothing else. In terms of bus service, as I mentioned, the overall methodology we stay consistent and similar to previous years. We don't book and over-reserve for the sake of over-reserving and offsetting our result. What happened this year, different from the previous years, basically is the change in the underlying Article 11 pattern. And because we have majority of the Saudis in the market, our utilization of Article 11 providers are higher than everyone in the market. Hence, the impact of Article 11 from our portfolio is higher than the market. So whatever release in the financials is driven by the change in the behavior that has to be offsetted from the bus surface. And this is the general basically story about why we're seeing bus surface movement as well as the release of onerous contract.
Clear. Just one follow-up here. I mean, I get your point that Q4 is typically weak for insurance companies, but 100% loss ratio or incurred claims ratio of over 100%. This is twice in last 2 years. So, and before in 2023, that was not the case. I think the year before also that was not the case. I'm just trying to understand here is if that is the case, then can we expect that prices will increase further in 2026, or you're okay with the margins that you're making on at the insurance service result?
So I'll take that one, Madhun. If you are rightly so. However, if you look at the net income from insurance contracts held, it was negative even in the year 2023. However, the trend was higher in the year 24 and 25. And I just want to point out that the year 25 have seen an improvement. Now, whether you should expect higher prices to correct or not, I mentioned earlier that this should be the case, not only because of the current loss ratio, but we do see the trajectory of the inflation continuing. So in all cases, you should expect price adjustments to continue until the overall net insurance results go back to the normal trend, which is closer to 23. So that's what we are aiming for in the coming period.
Thank you. And can I ask one more question, Ahmed, if you don't mind?
Do you mind if we just go back to the queue and then if we still have time? Thank you very much.
Yeah, sure. Yeah.
We'll take questions from the line of Talal. Please unmute yourself, introduce yourself as well, and go ahead with your questions.
Assalamu alaikum. Yes, this is Talal Irdan from Istismar Capital. Just a question regarding the recent renewed contract with Saudi National Bank. Just if you can share if there is any significant changes to the table of benefit or the number of employees. And also if you can share the pricing environment in the large corporate segment. Did you see a similar competition to the previous years in terms of for the year, large corporate segments? And thank you.
Sorry, Talal, I cannot disclose private information about a contract to the client. However, regarding your point, as always, there has been some changes for our clients in general when it comes to benefits offered. However, it's not a trend, and it's not a general trend that I would say everyone is taking, but there has been some changes similar to any other year. So nothing unique for this year compared to the previous years.
Thank you, Had.
Thank you, Talal.
Right, I'll just take a couple of questions from the chat and I'll then return to whoever still had follow-ups and we didn't cover. All right, Abdullah Shamsan from A&B is asking, why is there always a divergence in the expected inflation from Article 11? For example, in 2024, at the beginning of the year, you expected 2.9%, but the realized number was 3.5. And the same case was in 2025, where initially it was 2%, and then the realized part was 2.6. To his point, why should we expect lower inflation from Article 11 in 2026, despite the government entering Nafis, and this could limit your ability to reject claims?
Okay. So first of all, allow me to highlight that in every year we have sets of assumptions, and based on our assessment overall, there are some assumptions that are higher or lower. However, the general trend, we are meeting our expectation year on year. Hence, the consistent loss ratio that we have with only 1 point up or down. So this is the first point I wanted to highlight regarding the assumption. And I just want to highlight one more thing before moving to Nasser to add anything. But to anticipate Article 11 claims, there are multiple things that you need to take into consideration, which is one, the readiness of the entities. So you see hospitals that are submitting certain services only expand in their submission throughout the year. And then you see hospitals that did not used to submit before starting the submission. And there are still many providers and hospitals that are not submitting yet. So the whole model is built on assumptions on the readiness of the government entities, which you cannot anticipate exactly. However, when you take Article 11 and the other assumptions overall, we are in the same ballpark we are anticipating. Some year Article 11 is higher or lower, but I mean, there is no announcement or an official estimate on number of hospitals that will be ready. You have to anticipate and keep updating your model as you go, depending on the month-by-month claim you see. And Nasser, please feel free to add anything I might have missed.
Thank you, Hatem. Maybe I echo your message. The number of covered provider are not known. So you start the year with 200 provider, and then you ended up with 300 provider. This by itself is a challenge. The other one is basically the readiness of each and every provider. So the quality of the submission and how ready and mature the provider is different, and we need to basically forecast that as well. So these two variables always impact our projection for Article 11. There are the other part of the question, which is the projection of next year. So again, because the overall projection or the ultimate projection for Article 11 is already estimated relative to this year. So according to this year, we built our next year projection. And next year projection is a factor of how many providers are not yet listed as accredited provider, as well as how many of the current provider are not submitting in the right time with higher maturity. So we complete basically and project according to that information. Hence, you are seeing 2% expected inflation from Article 11 providers, because in general, the majority of the providers today are listed, and only few are not listed, and the overall maturity is enhancing. So that's why we're estimating 2% inflation of Article 11 provider next year.
Understood. Another question in the chat as well. I think it's more a clarification rather than just a direct question. The corrective measures that you have taken so far, was it only to offset the inflation or the higher than expected inflation that you started to see in the second half of 2025? Or were they also taking into consideration the expected inflation in 2026? The explanation that he added next to the question is, if medical inflation in 2025 was 20% and we're expecting another 20% in 2026, did you kind of reflect a kind of a cumulative 20% overall in your current repricing strategy?
So the answer is, Ahmed, is yes. We did consider both. As you've seen we did project the inflation to continue being 10% for the next year. So in our correction, we've anticipated the inflation of the year 25 to go up to 10% and continue into 26. So we did consider both in our pricing.
Right, understood. Another question in the chat, can you please explain to us the drivers behind the volatility of net expense from reinsurance contracts held on a quarterly basis, and how should these trends be interpreted going forward?
Sure, you can allow me, Hatem, to take this. So today our reinsurance contracts are a quota share arrangement, and they work in an inverted manner to our claims. So the healthier the book, the less recoveries and the more you have premium ceded, and accordingly you should have a larger expense. The more deterioration you have to your margins, which means higher claims, you should expect higher recoveries, which in turn would lower the reinsurance expense. So the way to look at it is to look at it in complete opposite manner to our movement for claims and insurance service contracts. They move hand in hand, but typically sometimes you have certain lags and recoveries between the reinsurance and the claims. However, you should look at it in an inverted manner.
Understood. Sorry, 1 second, I'm scrolling. Do you have an updated full year guidance or outlook for the growth in the gross written premiums for 2026? And if any of the initiatives highlighted by the insurance authority and or competitive pressures can impact this into the year?
Sure. So the guidance we've been following is the guidance that has been issued in CHI report a couple of years ago on the growth of the sector. And actually, it was issued back in 2022. And if you've been tracking it, we've been hitting the higher end of that projection, the optimistic view of the market. So even for us in terms of guidance, we are following that trajectory. And now with the insurance authority strategy release, it's more or less in the same trajectory, a bit higher if we hit those numbers from now until 2030. So I'd go back to that trajectory in the report as a guidance on the market trend.
Understood. One other question. So you've mentioned that one of the things that you've mentioned is throughout the whole repricing strategy and everything, you can go back, or at least the target initially is to go back to 2023 levels. And a follow-up that we got to that is, would you expect it to still in the longer future or longer term, do you expect it to still be within the same range or even the higher end of the range, or in the future efficiency initiatives could drive further upside to this level?
Yeah, so what I was talking about is the correction behind repricing the portfolio. However, our efficiency initiatives to optimize claim spend should come incremental to that to improve our loss ratio by 1% more. And the bigger the portion of the claims we are handling, the more control we have over the optimization and the medical outcome for our members. So that should come ideally on top of our effort to correct the portfolio, the underwriting portfolio.
Understood. Right, we'll take questions from the line of Shog. Please introduce yourself and go ahead with your questions.
Hi, this is Shog Shahrani from Newburger, Berman. Thank you for the call. Just to follow up on what you mentioned, Hatem, regarding the improvement in 1% in the combined ratio. Is it like, which base are you talking about? Is it the year 2024, 2025? Like, when you're talking about the improvement, which base are you basing on the improvement? That's my first question. My second question is regarding
So,
like, yes,
sorry,
go ahead.
Shah, before you go, just to understand you correctly. So you're saying the correction from repricing.
You mentioned
Or
twice that the loss ratio will improve from pricing, first element. Second, you mentioned that Care Connect contribution over like the full impact تقريبا would be تقريبا 1% improvement in the loss ratio. So these two elements, are you talking in the same base, 1% from both of them?
Sure.
This is
Sorry,
my
and the second.
Yes, so this is my first question. My second is like, would you see a case for like the cost from Care Connect and the spending that now you're mentioning that you want to enter into clinic, etc. Do you see a case where this cost will mask the improvement from the pricing, since that you're booking the cost for the physician and the direct cost for insurance? So do you see like the benefit will be extended over like few years, given that you have a ramp up period for the clinics?
Sure. So what I was referring to when I said we have an improvement is actually when you see this year our ratio worsened by 1%, and that's what we are aiming to correct for in 2026 through repricing the book, which already started a while ago. And what I was saying is at full maturity, our entrance into provision through Bupa Care Connect should improve it by 1% more. So 1% better than the closing of 24. So yes, I am saying this should come on top, ideally.
Clear.
And
So
this is it is related to your second point. So there will definitely be a ramp up. However, what we have seen from the Bupa Group experience globally is for the long term, it enables us to hit not only our financial targets, but also our customer experience and healthcare outcome improvement targets, which on the long term ensures better satisfaction from our customers, higher renewal of our book, and more clients to gain on the long term. So even if there is a ramp up period at the beginning, which, by the way, we've started for the past 2 years, eventually this is expected to be net positive for Bupa overall.
very clear. Thank you so much.
Thank you, Joe.
Right, we'll take just one final follow-up from Varuna, and then I'll hand it back to management for any closing remarks. Varuna, please go ahead. Varuna, please unmute yourself and go ahead.
Yeah. Hi. Thank you. Just a quick question on the Care Connect. So you mentioned that you'll be opening 2 integrated clinics in 2026. So I want to know whether there's like what is the long-term plan when it comes to this clinics network, considering that you plan to cover 10 to 15% of the member base. Can we tie that into that target? I mean, how many clinics and which regions that you expect to have this?
Mahsen, you want to take this one?
Yeah, I can take that, Hatem. Thank you for your question. So basically, I mean, the idea for Bupa Care Connect is becoming an integrated care provider with the insurance. And as Hatem mentioned, this has been proven successful in other markets. And basically, the way we operate today, as we mentioned earlier, is that we started with a digital first experience, enabling our members to use our digital first services when it comes to digital consultation, to medication delivery, home-based labs, home-based services, physiotherapy at home, etc. All of these services created some sort of a convenience setup for us. And the physical clinics are coming at the right time, where the engine that we have, created for the last 2 years will be complementing the ecosystem with physical presence, starting with Riyadh, and that will be expanding into the 3 regions. And ideally, what we plan to do is to be at proximity of our population, and that will come up with different formats of clinics, some in bigger size, some in smaller size. And essentially, theoretically speaking, the idea is to have a different model from the existing clinics or provider networks, where the existing ones that are within the network, for instance, for Bupa Arabia, are mostly operating on a pull model, where they try to pull the member into their premises or facilities as much as possible, and that obviously create a huge customer acquisition cost. Our model is different. We work on a push model where we guide the members through our facilities based on condition specific, based on clinical diagnosis by our doctors. So the journey is integrated end to end, and that creates a better ramp up, back to the previous questions on the clinics, and better economics overall.
Right. We conclude today's earnings call with this question and answer. I personally want to thank Bupa's management for answering all questions patiently, and I'll also hand it back to you guys if you have any concluding remarks. Otherwise, we can end the call.
Thank you very much, Ahmed, and thank you all for attending and for your rich questions and discussion. It's great to see the level of attendance, and happy to answer any further questions you might have in the future. Thank you.
Thank you.
Thank you, everyone.